In 2015, the average price of a new car in America was about $34,000. Today, in 2025, that same average is over $50,000. That's a 47% increase in just 10 years. And before you say, well, that's just inflation, let me stop you right there. General inflation over that same period was about 33%. So cars got 14% more expensive beyond normal inflation. But it gets worse. When you factor in interest rates, because let's be honest, almost nobody pays cash for a car, the situation is brutal. In 2015, the average car loan interest rate was around 4%. Today, it's over 7%. So you're paying 47% more for the car, and you're paying nearly double the interest rate to finance it. A car payment that would have been $450 a month in 2015 is now $800 a month for essentially the same vehicle. If you've been wondering why you can't afford a car, even though you make decent money, you're not crazy. Something fundamental broke in the car market over the past decade. And today, I'm going to show you exactly what happened, why it happened, and who's profiting while you're getting squeezed. Let's start with some cold, hard numbers, because this isn't just a feeling, this is mathematical reality. In 2015, the average transaction price for a new vehicle was $34,000. The median household income was about $56,000. That means the average car cost roughly 61% of median household income, or about 7 months of income. Fast forward to 2025, the average transaction price is now $50,500. The median household income is about $80,000. Do the math? That's 63% of median household income. So on the surface, it looks only slightly worse, right? Wrong, because we haven't factored in interest rates yet. In 2015, if you financed that $34,000 car at 4% interest over 60 months, your monthly payment was about $625. Total interest paid over the life of the loan? About $3,500. Total cost? $37,500. Now let's look at 2025. You're financing $50,500 at 7.5% interest over the same 60 months. Your monthly payment is $1,001. Total interest paid? $9,800. Total cost? $60,300. You're paying $22,800 more for basically the same car. A 61% increase in actual out-of-pocket cost. And that monthly payment jumped from $625 to $1,001. That's an extra $376 per month, over $4,500 per year, just for transportation.
But here's where it gets really insane. The average car loan term has also gotten longer. In 2015, the average loan was about 67 months. Today, it's over 73 months, and increasingly, people are taking out 84-month loans, 7 years to pay off a car. Why? Because it's the only way to make the monthly payments somewhat affordable. But longer loans mean more total interest paid. That $50,500 car financed over 84 months at 7.5%, you're paying over $13,600 in interest. Total cost? $64,100 for a car with a sticker price of $50,500. You're paying 27% more than the car is worth, just in interest. So what happened? Why did car prices explode over the past decade? There are 5 major factors that converge to create this mess, and most people don't fully understand them. This is the big one that everyone talks about but doesn't fully understand. During COVID, in 2020 and 2021, car manufacturers shut down production because they thought nobody would buy cars during a pandemic. They canceled their orders for microchips, the semiconductors that run everything in modern vehicles. Meanwhile, consumer electronics companies, making laptops and phones and gaming consoles for everyone stuck at home, bought up all the chip production capacity. When car manufacturers realized people actually did want to buy cars, maybe even more than before because nobody wanted to take public transit during a pandemic, they tried to restart production, but the chip manufacturers had already sold their capacity to other industries. There was a global shortage. This meant car manufacturers couldn't build enough vehicles to meet demand. Basic economics kicked in. When supply crashes and demand stays high or increases, prices skyrocket. Dealerships had empty lots. If you wanted a car, you had to pay whatever they asked because there were 10 other people willing to pay the same price. Manufacturers stopped offering incentives and rebates. Dealerships started charging markups above MSRP, sometimes $5, $10, even $20,000 over sticker price for in-demand models. A truck with an MSRP of $60,000 was selling for $80,000 because people were desperate and dealers could get away with it. The chip shortage has mostly resolved by 2025, but here's the thing. Prices didn't come back down. Once manufacturers and dealers realized people would pay $50,000 for a car, they had no incentive to lower prices. The market had reset at a higher baseline. This is called price stickiness. Prices go up quickly when there's a crisis, but they don't come back down when the crisis ends because companies don't want to leave money on the table.
In 2015, and really through most of the 2010s, interest rates were historically low. The Federal Reserve kept rates near zero to stimulate the economy after the 2008 financial crisis. Car loans were cheap. 3 to 4% was normal. But starting in 2022, the Fed began aggressively raising interest rates to combat inflation. The federal funds rate went from near zero to over 5%. Car loan rates followed. By 2025, the average car loan rate is 7 to 8%. And if you have less than perfect credit, you're looking at 10 to 15% or higher. Here's what this means in real terms. Every percentage point increase in interest rate adds significant cost to a car loan. On a $50,000 loan over 60 months, the difference between 4% and 8% interest is about $5,300 in extra interest payments. That's $5,300 you're paying just for the privilege of borrowing money that doesn't go toward the actual car. And because car prices are higher, you're borrowing more, which means interest costs hit even harder. It's a double squeeze, higher prices and higher interest rates. Cars today are fundamentally different machines than they were 10 years ago, and that's driving up costs in ways most people don't think about. In 2015, a base model car might have had air conditioning, power windows, a basic radio, and that was it. Today, even base models come loaded with technology. Backup cameras, touchscreen infotainment systems, Bluetooth connectivity, multiple airbags, advanced driver assistance systems, lane departure warnings, automatic emergency braking. Some of this technology is now legally mandated. Backup cameras have been required on all new cars since 2018. These features add cost. Manufacturers will tell you all this technology makes cars safer and better. And in many cases, that's true. But it also makes cars more expensive to build and more expensive to repair. A replacement side mirror that used to cost $50 now costs $300 because it has cameras and sensors built in. A fender bender that would have been a $500 fix now costs $3,000 because you damaged sensors and cameras that need recalibration. Insurance costs have skyrocketed. Partly because of this, modern cars are expensive to fix. And here's the cynical part. Manufacturers pushed luxury features down into mainstream vehicles not because consumers demanded them, but because it allows them to charge more. They eliminated cheap, basic models almost entirely. Try to find a truly basic, no-frills new car today. You can't. Even base models now start at $35,000 to $40,000 because they're loaded with features you didn't ask for and can't opt out of. The industry calls this content creep, and it's a way to justify higher prices while making it impossible to buy a simple, affordable vehicle.
In 2015, sedans and small cars made up a much larger share of the market. Today, trucks and SUVs dominate. About 80% of new vehicles sold in America are trucks, SUVs, or crossovers. These vehicles are significantly more expensive than sedans. The average sedan might cost $37,000. The average SUV or truck is $50,000 to $65,000. So part of the price increase is simply that Americans are buying more expensive vehicle types. But why? Is it just consumer preference? Partially, but it's also because manufacturers push the market in that direction. They make much higher profit margins on trucks and SUVs than on sedans. A Ford F-150 has a profit margin of around $10,000 to $12,000 per vehicle. A Ford Fusion sedan had a margin of maybe $2,000. So Ford, GM,
Toyota and others stopped making sedans or reduced their sedan lineups dramatically. They focused production and marketing on high-profit trucks and SUVs. Consumers didn't have a choice. If you want a new vehicle, you're buying a truck or SUV whether you need one or not, and you're paying the premium price that comes with it. There's also the cheap credit factor. When interest rates were low in the 2010s, people could afford bigger monthly payments, so they bought bigger, more expensive vehicles. Dealers would say, for just $50 more a month, you can get the SUV instead of the sedan. And people took the deal. Now those people are stuck in a market where even the affordable options are trucks that cost $55,000. Let's talk about the dealership model, because this is where consumers get absolutely screwed. In most states, manufacturers can't sell directly to consumers. They have to go through franchised dealerships. This is a legal requirement that protects dealerships from competition. Tesla has fought this for years, and they've only been able to sell directly in a handful of states. Everyone else has to deal with dealerships. Dealerships have enormous power in the transaction. They control inventory, they set prices above MSRP if they want, they add mandatory dealer fees that can be thousands of dollars. They push financing with marked up interest rates where they make money on the loan. They upsell warranties and add-ons. During the chip shortage from 2020 to 2023, dealerships were charging $10,000 to $20,000 over MSRP and making record profits. Even now in 2025, with inventory returning to more normal levels, many dealers are still adding markups of $3,000 to $5,000 or more on popular models. And here's the thing, there's no transparency. Every dealership charges different prices for the same car. You have to negotiate, which most people hate and are bad at. The whole system is designed to extract maximum profit from consumers who have no real bargaining power. You need a car to get to work, to live your life. Dealers know this. They know you'll pay what they ask because you don't have a choice. And unlike most industries where competition drives prices down, the dealership franchise system is legally protected, so there's no real competitive pressure. Now let's talk about used cars, because it's not like you can escape to the used market anymore. Used car prices have also skyrocketed. In 2015, a 3-year-old used car with 30,000 miles might cost about $23,000, about 68% of its new price. Today, that same 3-year-old used car costs around $39,000, about 77% of its new price. Used cars are holding their value much more because new car inventory was so constrained from 2020 to 2023. People who couldn't find new cars bought used, driving up used prices. And now, even though new inventory has recovered somewhat, used prices haven't come down proportionally. Plus, the used cars available today are more expensive to begin with because they're trucks and SUVs, not sedans. And they come with all that expensive technology that's costly to repair when it breaks. A 10-year-old car today has way more things that can go wrong than a 10-year-old car in 2015. That backup camera, that infotainment system, those sensors, they all fail eventually, and repairs are expensive. So even the used market isn't the escape valve it used to be. Let's talk about what this means for actual people, for your life, for your budget. Transportation is not optional. For most Americans, you need a car to get to work, to buy groceries, to take kids to school, to live a normal life. Public transit doesn't exist in most of the country. You can't just decide not to have a car. So when car prices increase 50% and interest rates double, you don't have a choice. You pay it or you don't have transportation.
And this is eating into household budgets in devastating ways. The average monthly car payment in America is now over $750. For many families, it's over $1,000 because they finance the $55,000 or $65,000 truck or SUV. That's $9,000 to $12,000 a year just for the car payment, not including insurance, gas, maintenance, or repairs. For a household making $80,000, that's 15% of gross income going just to the car payment. Add in insurance at $250 a month, gas at $200 a month, and maintenance, and you're easily spending 25 to 30% of your gross income on vehicle costs. That's approaching what most people spend on housing.
This is why people are drowning financially. You need the car to work, but the car payment is so high that you can't save money, can't build an emergency fund, can't invest for retirement. You're trapped in a cycle where you're working to pay for the car that you need to get to work. And when the car finally gets paid off in 6 or 7 years, it's old and needs expensive repairs, or you're pressured to trade it in and start the cycle over with a new loan. Here's what really gets me. Your parents could buy a car with 4 months of income in the 1990s or early 2000s. You need 7 to 8 months of income, and you're paying double the interest rate to finance it. This isn't because you're bad with money or because you're buying cars you can't afford. It's because the entire car market restructured in ways that benefit manufacturers and dealers while squeezing consumers. Manufacturers killed affordable sedans and pushed everyone into expensive trucks. Dealers mark up prices because they're legally protected from competition. Interest rates doubled. Supply shocks gave everyone an excuse to raise prices, and then prices never came back down. And there's no relief in sight. Manufacturers have said openly they're not going back to the old pricing model. They've discovered that consumers will pay these prices, so why would they lower them? Dealerships are making record profits, so they have no incentive to stop marking up vehicles. Interest rates might come down slowly over the next few years, but they're not going back to the 3% of the 2010s. And the shift to electric vehicles is only going to make this worse in the short term. EVs are currently more expensive than gas vehicles, and while operating costs are lower, the upfront price is brutal. So where does that leave you? Honestly, there are no great options. You can try to keep your current car running as long as possible, which is probably the smartest financial move if your car is paid off. Every year you can avoid buying a new car is a year you're not taking on an $800 monthly payment. You can buy used, but make sure to get a pre-purchase inspection because modern cars are complex and expensive to fix. You can shop around aggressively for the best interest rate. Credit unions often beat banks in dealership financing. You can avoid dealer add-ons and extended warranties that are usually terrible deals. But ultimately, this is a systemic problem that requires systemic solutions. We need direct-to-consumer sales to break the dealership monopoly. We need manufacturers to actually make affordable basic vehicles again instead of only producing $50,000 trucks. We need better public transit so people aren't forced to own cars just to survive. These aren't radical ideas. They're how other developed countries handle transportation. But in America, the car industry has enormous political power, and they've successfully structured the market to maximize their profits at your expense. The affordable car isn't coming back. That world is gone. But the $50,000 car payment that eats a quarter of your income isn't inevitable. It's the result of deliberate choices by manufacturers to kill affordable models, dealer monopolies that eliminate competition, supply shocks that reset prices higher, and interest rates that doubled the cost of borrowing. You're not failing at personal finance. The market is structured to squeeze you. And if you think car prices are insane, wait till you see what happened to weddings. Your grandmother's wedding cost $500. Yours will cost $35,000 or more. There's a story involving De Beers diamonds, the wedding industrial complex, and how an entire generation got convinced that you have to spend a year's salary to prove you love someone. That's the next video. If this video helped you understand why you can't afford a car, even though you work hard and make decent money, hit subscribe so you catch the wedding cost breakdown. And drop a comment telling me what's killing your budget the most. Car payments, rent, student loans, healthcare, childcare, whatever. I want to hear from you. See you in the next one.